Okay. Thank you so much for joining us on the Dwelling Show. I'm your host, Ola Dantes. I've got an incredible and pretty funny guest with us today, Josh Etin? No, I'm
Eitingon.
just Edigon. I just butchered that, but Josh, it's so good to have you on the show today. How you doing?
Thank you. Thank you. Doing well. Good to be here. Thanks for having me.
No, my pleasure. Josh, I'm sure you can do a way better job than I can. Can you just kind of tell our listeners a little bit more about who you are, what you've been doing, and kind of what you've been doing lately, actually?
Sure. I'd love to. So, like you said, my name's Josh Eitingon. I've been investing in real estate since back in 2012. I sort of got into this world pretty entrepreneurially when I was working for a software company, and I read a lot of books, probably like a lot of listeners do, Rich Dad Poor Dad, and ABCs of investing, and a lot of common books, and it just made it made sense. So I jumped in. I was connected to a property manager in the Midwest. He helped find me a short sale deal, and while I was still living at home, paying my dad rent to live in my own bedroom, I basically syndicated a 20-unit property as a short sale in Cincinnati, and it was distressed, occupied by 4 tenants of the 20, and worked to turn that around basically. From there, I was hooked, and trust me, it wasn't easy, and I got a little bit beat up as part of it, but ended up being a success, and kept doing a deal or so a year. Ultimately left software, went into real estate full time, first as like an analyst, then an acquisitions guy, where much of my responsibility was flying around the Southeast to just uncover opportunities for multifamily investing for larger deals, 200 unit plus deals. And after 4 or 5 years with them, then I peeled off, co-founded DXE Properties, which is our investment group here. And our focus has been predominantly multifamily, value add. I really leveraged a lot of the relationships that I had built just professionally to bring in-house. And we're looking for what a lot of people are looking for: the value add, something with a story, off market, just trying to create some unique value. And then we also have done a few opportunistic projects, a little more locally. We own neighborhood retail. We've done a couple smaller condo projects, and just looking to grow organically, basically 2, maybe 3 deals a year, and hope to be around for a very long time.
Yeah, thank you so much for that introduction. Really appreciate it. You said a bunch of things that I want to touch on. I mean, I love the fact that your dad is making you pay rent. I wish I could charge my babies. I mean, she's only 3 and one is 2 months old. I wish I can charge them rent. Um, but that's gonna definitely keep you on your toes, right? And make you also a little bit more. So 20 units. Let's go back. So you already know these books, ABC of real estate investing, Rich Dad Poor Dad, the quintessential classic, right, for many real estate
Mhm.
entrepreneurs. And then you went from that to a 20 unit. That's pretty impressive. I mean, can you kind of walk us through how did you find that deal? How did you fund it? And just kind of the story, what you learned, the good and bad, because you said it was a bit of a struggle. Trust me, I can imagine. So just
Sure.
kind of tell us a little bit more about that story.
Absolutely, and I'll put a bunch of disclaimers out there because I think that investment, while I think I did a lot right in just identifying value, it's risky to jump into. At the time, I was 25 and really felt like I had very little to lose. I was looking at a lot locally. I'm on Long Island, New York, and it's very, very challenging to buy existing rental property that just makes economic sense. So I was looking at similar price, like 4 families, to maybe live in one and rent out the other 3. But I just I was attracted to the potential yield in some of the markets outside of where I lived. For better or worse, I think there's risk associated with any strategy for sure. And much of the risk for that first deal was just managing a renovation from halfway across the country. But I was connected to a property manager. I did a lot of local just networking, went to RIAs, and it was a property manager that another investor had worked with. And I just spoke to him a lot. I went out there into the market, met with him, and he understood what I was looking for, and he helped find this opportunity that was off market, directly working with the servicer at the bank. And I basically paid him a wholesale fee to buy it, and then he managed it also and helped implement the value add plan.
So that's awesome. So it was a property that was in foreclosure, right? So this property management company helped you with kind of repositioning the asset. So do you still own that asset right now? How is it doing? Did you get rid of it? What are the major things that you learned for somebody maybe who is thinking of going into multifamily and probably starting at a kind of 20 unit mark?
So ended up getting rid of it. Held it at probably 18 months or so. So this was 2012. The world sort of starting to bounce back from a recession, and we turned it around pretty well. The issue and what we found was just the size was very difficult to achieve some real consistency. So 20 units, we really didn't have too much scale from an operating perspective. So, we saw income and expenses very lumpy and jumping all over the place, and just didn't see it as a long-term fit. So sold it. It was, I made a good, especially at my age, I made a good amount of money and was really excited to just be able to show like end-to-end success, and then move on to the next one. I think, in hindsight, it's 2020. It's probably worth, 50% more than it was 7 years ago. But I definitely wouldn't have done anything different on that first one in terms of just exiting. It's just, it's tough, especially C class. It was definitely a C class deal or a C minus deal on location. Those are very difficult to run without any real scale from a unit count perspective.
Yeah, so exited the deal you did. What was your next deal, and was that also kind of in the same area, or did you kind of change strategies a little bit? What was that like?
Yes. So the second deal also same market. It was in Cincinnati. Also found through that same property manager. Um, I would say, and that one was fine. A little bit less of a success than the first, but it was larger. It was 44 units, and it was a step up. And that was another, not long term. We held that for 2 or 3 years, and did one last deal in the market, a 62 unit deal, and then really shifted focus to the Southeast for everything moving forward.
Wow, so you kind of went from, you said 20 units and then 40 something and then 62. So you're definitely kind of moving up a little bit. At what point do you think, oh, wow, okay, so now I need to, kind of go up a little bit? How are you making those decisions to kind of scale up?
So part of it's opportunistic, that I'm letting the deal dictate in some cases whether or not I'm willing to do it. But for us now, we're big believers in the, I'll call it, small to mid-size multifamily space still. So I'll define that as like $5 to $15 million in acquisition price. We really can't do a deal smaller than $5 million, just because we're syndicating it. We're making a small fraction of that deal. So it just has to be worth our time, energy, effort. But in the same breath, we just really believe there's more unique opportunities in that less institutional space, sub $15 million, where you don't have large swaths of equity checks chasing these $20-30 million deals, driving up prices. We closed a deal 2 years ago that was still owned by the family that built it in the 70s. So you rarely see that when you're talking about much larger assets. Not to say it doesn't happen, but we've leveraged the success that we've had to really try to be able to compete really well against the people that are in that, I call it in between space, deal size wise.
Yeah, fascinating. Really, really fascinating. So one thing you mentioned as well as the beginning was you used to work in software and then you kind of fully transitioned into DXE. Just kind of curious for those maybe who are working at this point, did you think you had any skills from your job to now running DXE? And if so, what were those skills?
Yeah, that's a good question. I would say much of what I did was project management on the software side. So I think organizationally, there was definitely a benefit to that background. There was some Excel exposure, so that was certainly helpful from a modeling perspective. But I think more broadly, just the project management side really transferred well to the owner operator syndicator role with DXE.
So DXE, what does that look like today? How is the business like, and kind of what are your hopes for the nearest future? Yeah.
Sure. So we've done about $50 million of acquisitions. We, like I said earlier, I mean, we never want to be in a place where we're forced to do 10 deals in a year. We're just not built for it. I think what we do really well is just operate lean, low overhead. We are partnering with property managers in the markets that we're in that in most cases are large property managers that are working with us much because of the relationship that I've had with them in the past. So we think that even with these mid-sized deals, we're able to leverage sort of a higher level of management and oversight from us to really just be able to drive value. We will probably do 25 million dollars worth of acquisitions this year. And by the end of next year, 2021, we hope to have done $100 million worth of acquisitions. So, this business definitely benefits from scale and size and continuing to increase. But us like everyone, we're a little cautious about a lot of the unknowns that are floating around today.
Yeah, that's really fascinating though, because yeah, typically, syndicators just want to grow, 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 and grow, to like $100 billion or whatever. But I kind of really find what you guys are doing kind of similar in some form to what we're doing here at Dwelling. It's really understanding who you are, what you're built for, and what you can take not only as a business but as a person, right, at an individual level. And I think that's quite refreshing to hear. So you also went into retail. So are you guys thinking of maybe going kind of, in different asset classes, or do you kind of want to stay in your lane, I guess, in multifamily?
Well, I think I can't answer that without like mentioning COVID-19. I think it's tough to give an honest response
Yes,
to
yes,
that.
because retail got crushed a ton, obviously, by
Retail
COVID-19.
absolutely got crushed. We just did an update for our retail investments this week for closeout of Q2 or this past week. And, we were reading, I think it was Wall Street Journal, 65% of collections for retail just across the country. So scary time to be in retail. I think we got in sort of late. We bought these retail deals a year and a half ago in both cases. Both of them are neighborhood shopping centers, which fortunately have held up really well. One's anchored by a CVS that was essential and never closed. Then we also have a Dunkin' Donuts in there and a bank that have really held up well. And then the other one is like a laundromat and a deli, where fortunately that's a segment of retail that has held up well, and that was our thesis that we could create some value just because people are afraid of retail. Um, I think that those are doing well. They should continue to do well, but I don't know that I have the stomach to buy into retail right now. I think it's just very scary. There's a lot of retail in the country. We're perhaps overbuilt to an extent, and I don't know that I have the stomach for it. I think you have to have a long-term outlook to be able to get into it now.
Yeah, you're a smart man. Well, I think you mentioned something really, really important though. When you look at retail, though, it's the essential retail, right?
Mhm.
We don't anticipate to have another pandemic anytime soon. We're still in one, but at least if you were to go into retail, you really want to understand the dynamics of, okay, if I go into retail, is it a CVS or is it some other retail business that is really, really susceptible to a pandemic? That's something for us as investors that we need to start thinking about now, I guess.
Yeah, I mean, the whole world has gotten flipped, and obviously, most importantly, just a personal health, scare concern. But more than that, the asset classes that were perceived to be really safe and like the darlings of student housing and you know some sort of assisted living or retirement housing, it completely got flipped, and you would have never seen that coming. That's supposed to be the most safe niche that you could be in, so to speak. And then everyone just pressed pause immediately. So, broadly speaking, longer term, I think both will be fine, but for good reason. There's a lot of question right now in those spaces.
Yeah, definitely agree. I mean, we're going into the quick rounds. These are going to be quick questions, quick answers. You ready, sir?
Sure.
All right. First question. What makes you just unique? What is that differentiating factor that separates you from the next guy or the next girl?
Well, I think it's experience driven. I think I've had a lot of exposure to a really broad range of deals, starting with that small 20 unit deal to directly acquiring $100 million worth of just acquisitions from a professional perspective, and then tie that into my partner who has an institutional background. He's managed over $1 billion worth of capital projects. So we have just a really broad range of exposure and types of projects that we've been involved in.
Awesome. Second question. What was the last book that you read, and what was the one thing you picked up from that book?
Oh, I oh, this is going to drive me crazy. I can't. Powerhouse Principles. So, Jorge Perez, Miami, sort of like the co-founded related. It's sort of a, it is biography,
One of
but
the biggest real estate developers in the
yep,
country. Yep, Jorge
yep,
Perez, and yeah, yep, I
and
know.
and it's just a great story. Especially, I love the coming from nothing story and really just growing, putting it together himself. It's not overly technical, but it's also not overly fluffy. So I liked it, and you could see his personality coming through in the book. So a good, easy going to sleep type read.
Yeah, those guys are money. I think he partnered up with Stephen Ross of the related,
Yep.
yeah, related com I read the story, I read another book as well. And those guys basically built the condominiums in Miami back in the day, in the 80s. So yeah, great book.
Yeah. Yep.
Yeah, great book. Final question. Obviously, you're running DXE Properties. You've got a ton going on. You're running a business. You're closing deals. What do you do for fun?
Ah, so I also have a young child, only one. I have a year-old baby here.
Congrats.
Thank you. So, we're around friends and family mostly. Obviously trying to be as responsible as possible these days, but we love a good barbecue. We're near the water, so we like the beach, and that's my that's my escape for a
COVID,
little
yeah,
bit.
that's what we call it.
Yeah,
That's what we call fun during COVID-19 times. I totally can
exactly.
relate. Yeah. If there's somebody listening to this show and going, wow, I really want to maybe connect with Josh, or I really like what I'm hearing, what's the best place people can reach out to you, get to know you better?
Our website's probably best, dxeproperties.com. My email address is on there, or you could just reach out by contact us, and always happy to connect.
Josh, appreciate you. Thank you so much for taking time out today. Thank you.
Thank you.